What's up guys? Today I'm going to be sharing about one of the best opportunities for both investors and savvy homeowners to take advantage of in 2024. This particularly is going to gear towards people looking to get their first investment property. Now this is going to be the perfect opportunity for someone who's looking to house hack. Now house hacking is basically when you purchase a multifamily property, typically 2 to 4 units, and you live in one of the units and rent out the others, and the rent that you receive from those other units is able to either pay off the entire mortgage you pay monthly, or most of it, or even just reduce the amount of monthly overhead. So for that strategy, this is going to be an absolute game changer for that asset class in 2024. This product is only about a month old at this point, so it's really new and it's still very early on to take advantage of this. And so because of that, I do believe that there is a massive investment upside when it comes to a return on investment over the next couple of years in this asset class. So I'll go into all the details of that in today's video. But with that said, before we get started, my name is James Allen. I'm a licensed mortgage loan officer. I'm licensed in California, Oregon, Washington, Florida, Nevada, and Colorado. So if you're in any of those states looking to get a mortgage, renovation loan, construction loan, non-QM products, we got a lot of different options that we can help you out with. Definitely reach out to me. My email is in the description below. So check that out and reach out to me. So when it comes to buying a multifamily property that you plan on living in, for the longest time, you've, for the most part, had two options, which is one, FHA loan, putting down 3.5%, or a conventional loan, where for a conventional loan, you have to put down 15% on a duplex and up to 25% on a 3 to 4 unit property. So naturally, many people would lean towards the FHA loans because they're a much lower down payment than the conventional loans. However, today, FHA loans are not nearly as useful as they used to be. For one, FHA loans have what's called an upfront mortgage insurance premium. That's basically a 1.75% of the loan amount is going to be part of your closing costs. So if you have a loan amount of $750,000, you're going to take 1.75% of that, which means you're going to add over $13,000 in closing costs to your total. Secondly, you have mortgage insurance premiums for the life of the loan. This is a big problem because it never goes away even after 20% equity. So the only way you can get out of that is by refinancing out of your FHA loan into another type of loan that doesn't have that rule attached to it, like a conventional loan. The third problem with FHA loans is the loan limits. The maximum loan amount you're able to get with an FHA loan many times is lower than what you're able to get with a conventional loan. So as a result, there's many times you may find a property that you like, but the loan limit doesn't give you enough to qualify for even that 3.5% down that you were hoping to utilize. And finally, one of the biggest deterrents of using an FHA loan in today's landscape is what's known as the self-sustainability rule. And this particularly applies to 3 to 4 unit buildings. The self-sustainability rule basically states that your property needs to be able to pay off the mortgage, taxes, insurance, mortgage insurance, and any HOAs attached to the property with just 75% of the rents. Well, with prices having gone up so much and interest rates also going up so much, with rents not going up at the same speed as the monthly mortgage payment, it's proved to be really hard, particularly in high cost of living areas like Southern California, Northern California, New York. It makes it really hard to make the numbers work with that, and so it almost eliminates any possibility of being able to qualify with an FHA loan for those types of properties. Well, all of this is changed now because Fannie Mae brought to the table a 5% down conventional loan for 2 to 4 units. So that means what used to be 25% down for a 4 unit is now down to 5% down, and what used to be 15% down for a duplex is now down to 5% as well. Now this is an amazing investment opportunity for a couple of reasons. For one, it gives you the opportunity to get in with a lower barrier to entry into a conventional loan. So essentially, I get the ability to buy a $1 million property with just $50,000 down, knowing that my PMI will gradually go away once I get to 20% equity. Secondly, there's there's much less fees involved with conventional loans compared to FHA loans. Like we talked about, the upfront mortgage insurance premium that makes up 1.75% of the loan amount added to your closing costs, that is not a thing with conventional loans. So you save yourself the added closing costs, which can help you down the road if you're refinancing and all that stuff. But the other thing is, we talked about the PMI gradually getting paid off. What many people don't realize is if you're in a bull market and prices are starting to go up, and let's say you gained 20% equity in your home after you had bought it, well, you can actually, in many cases, reevaluate what your property is worth, getting a broker price opinion or even an appraisal in some cases. And if they determine that your property has 20% equity or more, then they can remove the PMI, even in less than a year sometimes. And finally, there is no self-sustainability rule attached to this program, which is fantastic news. You're not going to be automatically eliminated from being able to purchase a property just purely off that rule alone, which has been a major problem, especially in many of those markets we spoke about for the FHA loan. So that's a major game changer. And in addition to that, you can even use up to 75% of the rental income to qualify you towards it as well. So all of those things can help you get into the game with a low down payment and with the ability to be attached to a conventional loan where you can eventually get removed from that PMI extra cost you had to pay on a monthly basis. Now, all of this is good news for any homeowner that's looking to take advantage of a house hacking opportunity like this. But from an investment standpoint, I want to talk about a couple reasons why I think this is going to be a great type of investment to target, particularly throughout 2024 and 2025 for this type of 2 to 4 unit multifamily property. For one, there is a lower barrier to entry now. Remember, the FHA loan, particularly in many of the higher cost of living areas, the FHA loan wasn't even an option for many of those 3 to 4 unit properties because it was automatically eliminated from possibility thanks to the self-sustainability rule. So this opens up a whole realm of opportunity where now you don't need 15 or in the 3 to 4 unit case 25% down. You now only need 5% down to get into the game, and so that's going to unlock a huge amount of demand towards these types of properties. And we all know what happens when there's massive demand coming towards a certain type of asset class. That means prices are going to start going up. Secondly, with this type of product, you only have to live in the property for just 1 year, and then you can move out of it and keep it as a rental property. So you can hack it in a different type of way where you can hack owner-occupied financing, which is about 1% cheaper than what you get for an investment property. So if an investment property is at, say, 7%, you may be able to get in with 6% interest rate and take advantage of that interest rate for 1 year, move out, and now rent it out, and now you got your first investment property, and you can go and rinse and repeat, do it again. Imagine doing that with a $50K down payment on a $1 million property. Now you own $1 million of real estate. You rinse and repeat, you rent it out, you move out of the property, now buy another $1 million property with $50K. Now for a total of $100,000, you now own $2 million of real estate. Imagine $2 million of real estate going up in value by 10%. That's 200 grand in a single year you can make on appreciation just with a $100,000 investment. That's incredible. Not to mention the fact that mortgage rates are already starting to trend downward. We're expecting them to continue to go down further throughout 2024. So if you get in now with the prices today, before the interest rates go down and the prices start to balloon upward, you have a real opportunity to capitalize on getting today's prices, get the equity gain as more demand comes to these products, not only for the opportunity to get in with a 5% down payment, but also with interest rates going down in the future. That's only going to unlock further demand, pushing prices even more upward. So with that said, there is a lot of opportunity, particularly in this asset class I see in 2024, making it one of the best investments to make in 2024. Not only that, but it also gives you a strong personal financial situation if you can potentially lower your monthly mortgage payment to where you can almost live for free or even get close to that. I mean, that's a win-win-win situation where you are, lowering your cost of living and on top of that, getting a great investment opportunity paired with that together. So with that said, I hope you guys enjoyed today's video. If you gained some value from it, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Finally, follow me on Instagram @TheOutOfStateInvestor. And with that said, I'll see you guys on the next one.